Hello guys, so in this audio revision note we are going to learn the chapter number 4. Chapter number 4 is the international trade, and in this we are going to particularly start with unit number 1, which is the theories of international trade. So what is international trade? International trade is nothing but exchange of goods and services and resources between two or more countries. Okay, so between countries, that is known as international trade. Okay, so what happens in international trade is that first let's talk about currency. So usually what happens is there are multiple currencies which are involved in a international trade. Okay, so what are the advantages of international trade? There are a lot of advantages of international trade, few of which I'll explain you now. So here first is increased efficiency. So what happens is that when the person of some other countries importing inside your countries, your domestic producers, whoever is there, would also have to increase their efficiency to keep up with the competition which is there. Next is economies of scale. So what can happen is that since they are also exporting to a lot of country, our domestic producers will be exporting to a lot of other countries, so they can do mass production. So when they do a mass production, what will happen? They can also achieve the economies of scale. Okay, and then due to the enhancement of competition, the people who live in the country will also get better products at a cheaper price. Okay, and then whatever the domestic monopoly was there, that will also come to an end, because a lot of other players or other producers from other countries will also take part in distributing the goods and services. Okay, then what will happen in relation to foreign exchange reserves? When we import, we'll get a lot of foreign exchange, so that reserve is also very important for a country. Okay, then there will be a lot of economic growth. Okay, and also the human resources, whoever are there in the country, can also learn from the human resources outside the country, like what skills they have, how they work and everything, and also they can develop themselves. So human resource development can also happen. Whenever there is advantages, there will also be disadvantages. So what are the disadvantages of international trade? Is that first is loss of labor. So what they usually say is that whenever there is an international trade involved, if in case someone is setting up and manufacturing plant here in our country or whatever it is, then in such case mostly it is capital intensive only. So in such case labor lose their jobs, so there is a loss of labor also. Then what happens is that if the country from whom we are importing, like the outside country other than our country, if they have a greater economic power, they can exploit our country also. And then they say transmission of trade cycle. So here what happens is that in case if a country is going through recession and we are having a trade with them, then that recession can also pass on to our country. So the trade cycles can also transmit into our company. So whatever cycle is going there, if there is recession, it will come here. If there is inflation, it will come here. So that way. There may be also chances that you import a lot of harmful products. Then transparency might not be there, so there are a lot of the disadvantages also. Okay, so now we are going to start discussing the different type of views on international trade, or on how international trade should happen. There were a lot of views, so we are going to discuss it one by one. So the first is the mercantilist view of international trade. So the mercantilist view of international trade, what they say is, the person who wrote this theory, what he told was that you must usually, when you are in an international trade, when a country is participating in international trade, they must always look for increasing their exports only. Okay, they must always look out for increasing their exports only, because once they increase their export, they'll sell a lot of product, and in return from other countries they can get precious metals. Okay, the higher the precious metals they get in return of the exports, the richer the country is going to become. Why is here it is written precious metals? Is because at that time this theory was brought in, and at that time for exchange they used metals only in return. Okay. So here one more thing what he says is that you should increase your export is one thing. The second thing he says is that you must try to do is you must also increase your export, but you must also try to minimize your import. So minimize your import. How are you going to minimize your import? What you should do is you should charge very high tariffs on foreign goods, so that the foreign players are not able to sell in your countries itself. Okay, so this was the mercantilist view of international trade. Then the next theory is about the theory of absolute advantage. Okay, so in theory of absolute advantage, Adam Smith, what did he say was that he was always in support of an unrestricted trade. That means there must be no trade restriction between any two countries, and the international competition must be free. It must, the international trade must be only dependent on free forces of demand and supply. There must be no restriction and all. Okay, so here what he importantly tries to tell in this theory of absolute advantage is that you must do such an international trade where all the countries are getting benefited. You must do such an international trade that all the countries are getting benefited. So how will all the countries get benefit here is that what a country must do is, suppose if there is country A and if there is country B, okay, country A and country B is there, and what happens is that the demand is for rice and wheat. Okay, example, take the demand is for rice and wheat. So first we will start with rice. So what he says is that if country A has can produce a lot of quantity of rice in less hours than B, that means, I'll again repeat it. If country A can produce a lot of rice in less time than country B, suppose in 1 hour country A is able to produce 6 kgs of rice, whereas country B is only able to produce 2 kgs of rice. So in such case, A has an advantage over B, right? So the country which has an advantage, they should export that product, okay, so that they are able to earn more. Whereas now if you take wheat, example of wheat, now here what happens, B has an advantage over A. B is able to produce 10 kgs of wheat whereas in an hour, whereas A is only able to produce 5 kgs of wheat in an hour. Okay, so here what happens, clearly B has an advantage. So what they tell is then B must export wheat. So here what happen, A will export rice and import wheat from B, whereas B will import rice from country A and will export the wheat, because here B has advantage over wheat and A has advantage over rice. So like that you must function. So export whatever you are good in and import the rest of the things. So this is the kind of theory he proposed or he told. Okay, so here what they tell is exchange of goods between two countries will take place only if two countries can produce one commodity at an absolutely lower production cost than the other country. So than the other country, any one good you must be able to produce at lower production cost. Okay, so whichever nation has an absolute advantage in that good, they must export that product and import the other product. Okay, so I hope this is clear. This also regarding this I have also discussed in my economics practical, that sums video. If you would have done those sums, you would understand this theory better. Next theory is in relation to the theory of the last theory, absolute advantage. One country was doing better than the other country in one product, and the other country was doing better than the first country in one product. So both had an advantage over something. Now in comparative advantage, what they say is, if there is country A and if there is country B, country A is better in producing rice also and in producing wheat also. Country B is bad at producing rice also and wheat also. So here A has an advantage over both the type of goods. Now here who should export what and who should import what is a question mark, right? So here what you should do is that, first, in case I'll give you an example here, okay. So if country A is there, okay, country A is able to produce 6 kgs rice in an hour and country B is able to produce 1 kg rice in an hour. The same way, country A can produce 4 kgs of rice 4 kgs of wheat in an hour, and country B can produce 2 kgs of wheat only in an hour. So rice, country A is producing 6 kg whereas B is only producing 1 kg. So it has an advantage. Same way, wheat also, country A is producing 4 kg whereas country B is only producing 2 kg. So on wheat also it has an advantage. So in rice and wheat, both country A has an advantage. So here what you have to do is, you have to see the ratio of what B is producing. So B is only producing 1/6 the rice which country A is producing, because country A is able to produce 6 kgs whereas country B is only able to produce 1 kg. So 1/6 kg is what country B is able to produce. Okay, so 1/6 kg. The same way, if you see wheat also, wheat, country B is able to produce 2 kg, whereas country A is able to produce 4 kg. So 2 by 4, 2 kgs out of 4 only country A is country B is able to produce. So that is 2 by 4. So now you have to take the ratio of rice and also both wheat. What was rice? Rice was 1 by 6. So 1 by 6, if you divide, what will be the answer? 0.167. Whereas if you take the example of wheat, it is 2 by 4. So if you divide 2 by 4, the answer is 0.50. So here if you compare between the two products of rice and wheat, which is greater, you have to see in country B. So 1 by 6 is greater or 2 by 4 is greater? So 2 by 4 is greater. So country B must export in whatever it can produce greater. Country B should now export wheat, because wheat it is producing better than the rice. Okay, so here what they say in comparative advantages, we know that in both the products the country B is worst, but at least it has an advantage of wheat over rice, no? So let the country B at least produce wheat. So country A, you can produce rice and you can export it to country B. Country B, you please produce wheat. Even though A can produce more, it's okay, you still produce wheat and you export it to country A. So this is what they have told in theory of comparative advantage. So next is Heckscher-Ohlin theory of trade. Okay, so in Heckscher-Ohlin theory of trade, they talk about two things. One is capital and one is labor. So here first I'll tell you the other names of Heckscher-Ohlin theory. One is factor endowment theory, and it is also known as trade or modern theory of modern theory. Okay. So these are the different names of Heckscher-Ohlin theory. So here what they say is that if there are two countries, country A and country B, if country A is very good in producing labor intensive products, country A is very good in producing labor intensive products, and country B is very good in producing capital intensive products. So here what they should do is, country A must produce only those goods which is has labor intensive work. Okay, because it is good in that. The same way country B must only produce those goods which have capital intensive work, because country B is good in capital intensive work or technology, we can say. So here in such case what will happen is the labors from country B, okay, the labor, since in country B what is happening, they are only producing capital intensive goods. So in country B the labors will not have work. So what the labors in country B can do is they can shift it to country A. So the same way in country A, they are producing only more labor intensive goods. So here the capital is going waste. So country A can give the capital to country B, where they can produce capital intensive goods. Okay, so like that they must exchange their resources whatever are there. Okay, so this was the whole summary of unit number 1 of chapter 4. I hope you found it helpful. Hello guys, so in this audio lecture we are going to learn the unit 2 of international trade, or chapter number 4. So in this unit number 2 we are going to study the instruments of trade policy. So before we go on with the instruments of trade policy, let us understand what is trade policy. So trade policy is nothing but it is an instrument. Okay, so what the government will do is, with the help of this instrument or with the help of the trade policy, they will either try to promote the export and import of goods and services, or either restrict the import and export. Okay, so either to promote or restrict they are going to use. Fine. Then what are the types of trade policies? There are two types of, we can say, two instruments of trade policy. One is tariff measures and the other one is non-tariff measures. So tariff measures is price related, that is related to the price of the goods and services, whereas non-tariff measures is non-price related. Okay, so first let's understand about tariff measures. So what is tariff? Tariff means in simple terms custom duties, customs. So usually you would have heard, people either importing or exporting, they would pay customs at the border and then get their goods or services into their country or in their hands, or export it, whatever the case may be. So it is basically nothing but a tax or duty which is imposed on the goods and services which are either exported or imported. Okay. So there are different kinds of tariffs. So we are going to learn about that. Okay. So the first one is specific tariff. So specific tariff is a kind of import duty. Okay, on imports you put on this duty, where what you do is you tell them to pay tax on depending upon how many units you have how many units of goods you have imported. So this tax or this import duty is applied on the units of goods you have imported, number of units of goods you have imported. So higher the units, higher will be the tax, as simple as that. Okay, and it not only it is not important that it is only on the number of units, it can also be on the weight of the goods you are bringing in, or it can also be on the volume. Okay, yes. So the next one is ad valorem. So what is ad valorem tariff? So ad valorem tariff is nothing but on last in specific tariff we understood that it is dependent on the unit of goods, but here it is going to be in ad valorem tariff, it is going to be on the value of goods. So as a percentage they will charge like 10% on the value of goods you have to pay us. So like that they are going to levy a percentage on the monetary value of 1 unit of imported goods. So that is ad valorem tariff. Next is mixed tariff. In mixed tariff, what they will do is they will either charge specific tariff or they will charge ad valorem tariff. From whichever the government is getting more income, they will get that tariff. So example, they will tell you that you have to pay you have to pay 10% of import duty if you are importing 10,000 units. That is specific tariff. Or they can also say that you have to pay 10% of whatever value you are going to whatever value of goods you are going to import. So that is ad valorem tariff. So either this or that they will charge in mixed tariff. Whichever is going to generate the government higher income, that they will use. That kind of tariff they will apply. Next is compound tariff, or we also call it as compound duty. Compound tariff means they will apply both ad valorem tariff and specific tariff. So both they will apply. Okay. Next is technical or other tariff. So in technical or other tariff, what they will do is depending upon the content or the component of the goods that you are importing, they will charge. Example, if there is a good, or we can say if there is some mission or something. So in that if there are 10 batteries, you have to pay this much duty. If there are 10,000 batteries, you have to pay this much duty. So whatever the component of the good is there, that is inside the good, whatever components are there, on that basis they will charge a tax. On that basis they will charge a tax. Okay, yes. Next is tariff rate quotas. So tariff rate quotas, or we usually call this quotas. Yes, so here what they will do is that they will tell that whichever country is importing, if you import 10,000 units, then we will not charge you anything, or we will charge you very less. But in case if you are importing more than 10,000 units, then we are going to charge a very high rate. So quotas means if this much quota if you import, then it's okay. If it's more than that quota, then it's going to be charged high for you, like slab you will have. Okay. Next is preferential tariff. Preferential tariff is where they charge a lower tariff from one country, okay, than the rest of the countries. From one country alone, they will charge lesser amount of tariff on the same kind of good. Maybe they may be friends, okay, the countries might be friends, or they might have very good relations. So that preferential treatment they might give. Next is bound tariff. Bound tariff means you all know that there is a WTO, World Trade Organization. In that there are a lot of member countries. Okay, so what this World Trade Organization member countries do is that they bind themselves into an agreement. India is also a member of WTO. Okay, so India also will get into an agreement that it will not raise its tariff above a certain level. That maximum tariff it can charge is only 100 rupees or 1000 rupees or 10,000 rupees. So maximum limit it will set. So whatever happens, it cannot charge more than the bound tariff. Okay, so suppose it tells you that it will only charge 10% tariff. So above 10% it cannot charge. Okay, so that is bound tariff. Next is applied tariff. Applied tariff is nothing but if in bound tariffs, if you have told you are only going to charge 10%, but what you are actually charging is only 5%. So that 5% is going to be your applied tariff. So how much tariff are you charging in relation to the bound tariff? Are you charging the total bound tariff or lesser than that, or whatever it is? Okay, so that is applied tariff. Next is prohibitive tariff. Prohibitive tariff is a tariff which is set so high that the imports cannot enter at all. So high rate of tariff that you want to stop the imports coming into your country. So if you keep a tax like that or a custom like that, then that will be known as a prohibitive tariff. It prohibits other countries from importing into your country. Next, anti-dumping duties. So anti-dumping duties, what does it means is that first I'll tell you what the concept of this is. So what happens is that we'll take the example of India and China. Suppose China is there, and what China does is that it sells toys in India. We'll take the example of toys. So now what does China does is that in their market, okay, in their market they sell one toy for 100 rupees. Whereas what they do is the same toys, okay, what they'll do is they'll come to India and sell it at only 50 rupees. That is, then the domestic market itself, they will sell at a lesser price in a foreign country. Okay, whatever rate is going in the domestic country, lesser than that they will sell in the foreign country, or even lesser than the cost. Let it the toy cost, the cost of manufacturing that toy was itself 80 rupees, but here they will only sell it at 50 rupees in India. So here this is known as dumping. Okay, so this is how the manufacturers dump in a foreign country, so that what will happen is the domestic producers cannot compete with such a low price, and they will go away from the competition or die there itself, and this foreign country can make a monopoly the China can make a monopoly in India. So they will see to that Indian producers are not able to match to that toy at such a low price, and by that they will create a monopoly there. So this is basically how dumping occurs. So what is anti-dumping duties is that to offset. So if China is going to sell in India at 50 rupees, and at India the same toy is usually sold at 80 to 90 rupees, what they will do is they will tell that on 50 rupees you have to pay 30-40 rupees more tax, so that whenever they sell in India the price will be same as how the Indian sellers also sell it. It will come up to 80 or 90 rupees. So anti-dumping duties is a tariff which offsets the effect of dumping, because they should not get an unfair price advantage. The foreign firms should not get an unfair price advantage, so for that they use. Next is countervailing duty. So what is countervailing duties is that what the China, okay, again you will take the example of China and India. So what will happen is China's toy sellers are going to sell toys in India. So they are going to sell toys at suppose 100 rupees itself, okay. But what the Chinese government will do is they will tell that wherever you are exporting this goods, that means you are exporting goods to India, right? So in India you sell it at 50 rupees only, we will give you the extra 50 rupees. So here government will come and tell them that we will give you export subsidies, use that and sell it at a lesser rate in the Indian country, India, okay. So like that, if they say again, here the same problem will come. So what Indian government will do is to offset this artificially low prices. Because the governments are helping them, they have low prices, right? So to offset this, they will apply a tariff called as countervailing duties. So I hope you understood the different types of tariff measures. Now let's see the non-tariff measures. So what are non-tariff measures? Non-tariff measures are generally, we said there are few types of policies which the government will have, okay, due to which there can be effect on the international trade. Okay, so now when we are going to read the different types of non-tariff measures, you'll understand. So there are non-tariff measures can be divided into two parts. One is technical measures and the other is non-technical measures. So first let's start with technical measures. So under technical measure, the first measure is sanitary and phytosanitary measures, okay. So under phytosanitary and sanitary measures, what they tell is that here they will bring in a few policies that will protect the human, animal or plant life, okay. So what can happen is that they will make a strict regulation on a few contaminants or any toxins or any disease causing organisms. Okay, so from all of these, they'll try to protect. So in relation to that, they'll bring in some policies. Okay, so those measures will be known as sanitary and phytosanitary measures. Next is technical barriers to trade. So in technical barriers to trade, what they'll do is they'll set a few standards and technical regulations. Let's see, if you're going to import products in our country, then in such case, you should the product should be of this size, the product should be of this shape, this design must be there, this labeling must be there, this marking or this packaging must be there. Example, if you are importing some food item, you must in the packaging you must have to mention that how much carbs are there, how much fats are there, so all of those things. So like this, any kind of standards and technical regulations, they may tell them. And if in case any country is not going to follow this technical barriers to trade or the standards and technical regulations, information, then in such case they'll tell them, see, you have a technical barrier to trade, so we cannot help you import in the country, so the imports will stop there. The same way in sanitary and phytosanitary measures, what they will do is, in case if there is a product which is coming into India, which has a very harmful effect on human, animal or plant life, they will tell that, see, we cannot import your products because there are few sanitary and phytosanitary measures that we follow, and due to this we cannot help you to import in our country. Okay, next is non-technical measures. So non-technical measures, there are a few, we'll read that. First is import quotas. Import quotas is same thing as we read as quotas and tariff measures. No, so this amount of quota you can, only this amount of quota you can, import in our country. Like they will say that if a product is coming from China, only 10,000 units of Chinese products or Chinese toys can come into our country. That is, in 1 year only this much you can import into our country. Okay, so like that they will tell. So these are import quotas. Next is non-automatic licensing and prohibitions. First we'll understand what is automatic licensing. So automatic licensing means, example, we can say if we go to a yes, where do you get license? Example, we'll take driver's license. So here what they will say is that if usually what happens in our country, we will have a few regulations that we have to follow, a few documents that we have to submit to the RTO, and once RTO approves that, and after we take a test and pass in that test, we will get our license. Okay, so if anybody follows this properly, they can get a license. Government cannot stop us from getting a license. Okay, that is automatic licensing. But whereas non-automatic licensing means, here government, even though the country has followed all the policies and regulations that they have to follow to import into our country, even if they follow that, here the government will have a discretion whether they want to give the license or not. So here it is not automatic that if you have followed you can import. No, here government will also have a say. Okay, so this is what is non-automatic licensing and prohibitions. Next is financial measures. Financial measures means what they will do is, here see, the financial measures is used to increase the import cost by regulating the access to and cost of foreign exchange for imports. Okay, so they will make some terms of payment and make policies in relation to foreign exchange that the cost increases, okay, due to which the importers don't want to import into India anymore. Okay, next is trade related investment measures. So in trade related investment measures, here what they tell is that they will tell that a specified fraction of final good should be manufactured domestically only, that in India only you will have to manufacture either a specific fraction of final good, or also they'll tell you that whatever raw materials are there, you must only get it from India. Okay, so that raw material only if you get it from India, you can sell your final goods here. So like that they will put some trade related investment measures so that the investment flows into India, because if they're going to buy from India, then their money is going to flow into India, which is an investment to Indian economy. Okay, next is restriction on post sale services. Here what they will tell is that once you have imported a good into India, all the after sale services which is related to the good, if there may be repairing or if there may be any customer care, whatever after sale services is there, it should only happen in our country, then only you can import your goods. So like this, on restriction on post sale services also they can give. Then is rules of origin. So in rules of origin, what they will tell is that the governments who are there, sometimes if India and China is having like a cold war, here what they can say is there are a few products that you all know that are banned from China, that cannot come into India from China. So there are a few banned goods. So now China in this case, what they may do is they may sell the product, they may send that product to Hong Kong, and Hong Kong can sell it into India. But here what will happen is, what all people will think, it has only come from Hong Kong, so we can buy it. But when you see there is written made in China, then that is wrong, no? So here what they will do is, the government will see where it is made or where it has originated the good. So if it is originated in the country which is banned, they will also not allow the import of such goods. Final one is embargoes. So in embargoes, what they will do is, they will do a total ban on either import or export of any kind of goods and services to a particular country. Okay, this they can do for an indefinite period also, and they say that this embargoes which is there, this can happen mostly due to political reasons or health or religious sentiments also. So here this is embargoes is one of the most extreme form of trade barrier, because they can use this kind of trade barrier for an indefinite period, and they are going to do a total ban. So that's very extreme form. Okay, so this was the unit 2, and I hope you understood the unit 2 well. Hello guys, so in this audio lecture we are going to revise the unit number 3 of chapter number 4. So the unit number 3 of chapter number 4 talks about trade negotiations. So what is trade negotiation in simple terms? So simply, if you take an example of your day-to-day life, negotiation has always been a big part of our life. When we go on to buy our clothes also, we negotiate with the vendor and get our clothes at a lesser price or at a price which is beneficial to us. So imagine the situation when an international trade is happening. Okay, so international trade, when it happens also, there are a lot of negotiations that take place. Such negotiations are usually very, very complex processes. It is very, very time consuming, and it is not just like any common face-to-face discussion that you have. There are a lot of intricate details that goes into it, a lot of processes that go into it. Okay, because the both countries who are negotiating, they will have their own objectives that they have to fulfill. Okay, so in order to achieve their objectives, they will have to convince the other country and negotiate in such a way. So this is how basically an international trade negotiation happen. So now what we are going to study is that, so in relation to international trade negotiations, there were a lot of agreements that have taken place, so that these negotiations have a smooth, they run very smoothly, okay, and happen very smoothly. So the first, so I think we are going to study around 3 agreements in this unit. So the first agreement is regional trade agreement, or also it is known as RTA. So what is regional trade agreement? So regional trade agreement, here what happens is, as the name suggests, it is an agreement where people come and sign on the agreement and agree to the terms and conditions of it. Okay, so regional trade agreements, what happened was, the regional trade agreements, a group of countries came together, and what they did was, once they came together with an objective of reducing the trade barriers between their member countries itself. So who and all were the part of the group, or who and all countries signed the agreement together. All these countries came together and made sure that the barriers of trade which they have gets reduced, so that international trades become beneficial to each one of them who are there in the agreement or in this regional trade agreement. Okay, so there were a lot of types of regional trade agreements which you can go through by yourself. I am not going to be discussing it here. Examples are given in the book. Okay, so the next kind of agreement we are going to the next agreement that we are going to go through is the General Agreement on Tariffs and Trade, GATT. So this is a very, very famous agreement. So this is also an agreement where a lot of member countries came together and signed on it. But here in the General Agreement on Tariffs on Trade, they never called the countries who were participating in this agreement as member countries. They usually called these countries as either contracting parties or contracting countries. Okay, so here what they did was this, why first they came up with the idea of General Agreement on Tariffs on Trade. So here they came up with the idea that the liberalization which is happening, or the trade which is happening, it should happen more efficiently and effectively. Okay, because what happened after the Second World War, there was a lot of confusion among a lot of countries, there was a lot of unemployment, and that time there was a huge need of international trade to happen smoothly. So in such case, 23 countries came together and signed this agreement, which was known as the General Agreement on Tariffs and Trade. Okay, fine. Yes. So when did this GATT came into force? GATT came into force in 1st January 1948. Okay. So here what they did in this agreement was that they came up with a lot of tariff concessions that amongst our countries, amongst the contracting parties, or at least the member countries of GATT, they made sure that the tariffs whatever are there, or whatever taxes were there, they were they charged lesser prices. Okay, so concessions were given, and also they made a lot of rules too, so that in relation to the international trade. Okay, so what happened was that soon, so how, first I'll tell you how this GATT used to work. So GATT, when it used to resolve problem of its member countries, so what used to happen is they used to have something known as rounds. So they used to have each round in which they used to solve a lot of issues of their member countries. So they totally had 8 rounds. Okay, and each round usually used to happen in a gap of 2 years or 1 years, and this is how GATT usually worked. So what happened was that after 1980, so it was started in 1948, but by 1980s it started losing its relevance. Okay, why did GATT start losing its relevance? Was because the first thing was that the world was evolving very very fastly, and the international trade became even more complex. Okay, so the rules or whatever the policies the GATT followed, it became obsolete. Next, second, what happened was that the international investments had expanded substantially, which the GATT was not able to handle, and also all kinds of goods were not covered under GATT. For example, the agriculture related goods were not related under GATT. Okay, like tariffs on agriculture goods, that was not discussed under GATT. Okay, so these were a few things, and one more thing was that there was no very good dispute settlement system. In case there was a dispute, the countries found it really hard to settle them. Then also there was not an institutional structure. This was just an agreement on which all the countries were working. So what happened by the 8th round that happened of GATT, 8th round was known as the Uruguay round. So what happened was that by the end of Uruguay round, all the member countries of GATT decided that now we will abolish GATT and now we will start an institute. I mean, as an institutional structure. So that's when a third part comes in, World Trade Organization. So World Trade Organization was a plant whose seed was planted in the Uruguay round. Okay, yes. So this happened in Geneva. Fine. So this is how World Trade Organization came into picture. Okay. So what they did was to start World Trade Organization. Also, a lot of member countries have to join in that organization, right? So most countries signed the agreement of World Trade Organization by April 15, 1994, and then World Trade Organization as an institute came into force on July 1, 1995. So here what happened was that this World Trade Organization was an institutional framework which also had the qualities of GATT but was modified at a lot of levels so that it could, whatever deficiency were there in GATT, they resolved all those deficiencies and made better rules and regulations and policies in WTO. Okay, so then what was the objective of WTO? So the principal objective or the main objective of WTA was that the international trade should happen smoothly, freely, fairly. Okay, so this was the main motive of WTO. Okay, so there were a few principles, or we can also call it as a few guiding principles which WTO followed. So what were the principles, or what were the principles that the member countries of WTO has to follow? The first principle was that you have to trade without any discrimination. Okay, so the under WTO agreement, what it was written is that the countries, cannot normally discriminate between its trading partners. That means from whichever country they are importing or exporting, normally they should not discriminate between them. Okay, and what happens is, if suppose India is there and India, US and a lot other countries suppose are a part of WTO, then in such case, if India is helping US by lowering their trade barrier or lowering the tax rate for US alone, then in such case it should not only do it for US, it should do it for everybody. So if one WTO member is helping another WTO member, it should help all the WTO members in return. Here you cannot work with any kind of discrimination. The second thing is national trade principle. So this was the second principle. So here they told that a country should never discriminate between its products and the foreign products. It must always treat even the imported products or the foreign products as if it was, being made in their domestic area, because then there will be no discrimination. Third one was in freer trade. What they tell is that they tell that all the member countries should try lowering their trade barriers as much as possible, because this is the obvious means that will help in encouraging the international trade. So what does lowering trade barriers means? What does barrier here in means in particulars is that they must try to lower their tariffs. They must try to take out any imports, any bans if there is on imports, or any quotas, or any kind of restriction if they have. Okay, they must try to lower it as much as possible. Okay, next is predictability. So here as a principle, what they tell is that if a country is going to export to your country, or if you are going to import goods in a country, so they are or some other country is importing from you, then in such case those countries are going to make a lot of investment in your country. So in such case, the rules that you have here must be very, very predictable. Suppose what happens is China is exporting its toys into India. So what happens is every month India keeps on changing its import duty. Then in such case, what will happen? China will see that there is no predictability in India. One month they have this tax, next month they have this tax. We are not able to deal with so much of fluctuation. So there is no predictability in India at all. So in case of this happens, then there will be a lot of negative effect on the international trade that takes place. The confidence that the foreign companies have in your countries will substantially go down. So to avoid that, you must take measures to avoid that. Next is greater competitiveness. So what will happen is that here what they are saying is you must discourage unfair practices like export subsidies or dumping or countervailing. Not countervailing, the dumping, these and all you must try to totally eliminate such unfair practices. Then only the international trade will be a more healthier space. Next is special privileges to less developed countries. So WTO also gave special privileges to less developed countries. Like example might be that if any new policy was brought in, that means the less developed countries were given more time, or are granted granted a longer transition period to make adjustments. Okay, rather than the developed countries were only given less time, and a few other special privileges are also given to less developed countries under WTO. Then finally in WTO, one principle was that they had a very transparent, effective and verifiable dispute mechanism system, dispute settlement system or mechanism. This was one of the deficiency in GATT which was corrected here. So here what happened was that any dispute was arising out of any violation of trade rules, they used to try to settle it using any kind of consultation. If consultation did not work, then they would refer it to WTO. First the member countries have to consult between themselves and try to solve the dispute. In case if the dispute was not solved by those member countries, then in such case this would be referred to the WTO. Okay, what WTO used to do is that they would first create a stage by stage procedure. Okay, and a panel of experts will also be there who will give an opportunity and then give a ruling based on the legal grounds. Okay, so here whatever the dispute settlement body would say would be the final and would be the most binding. Even in WTO there were a few concerns, or we may say there are a few limitations, that this was very, very rigid, the rules were very rigid. They also used to say that the developing countries have a more favorable side here. The process is very slow here, it is very uncertain, and there is also sector biasness because agriculture was not included, right? Agriculture goods. So here also there were a few concerns, but now WTO is that one organization which takes care of the whole international trade. So this was the whole summary of unit number 3. I hope you found it helpful. Hello guys, so in this audio revision lecture we are going to learn the unit number 4 of chapter 4. So the unit number 4 talks about the exchange rate and its economic effects. So what is exchange rate? Exchange rate in simple terms, we also call it as a foreign exchange rate. It is nothing but the price of one currency if it is expressed in the terms of units of other currency, then it will be known as an exchange rate. It is nothing but the rate at which one country exchanges its currency for the currency of another country. That rate will be known as your exchange rate. Example equal to, you can exchange your 70 Indian rupees with 1 US dollar. Okay, so this is a kind of exchange rate. Then, so you can express exchange rate in two forms. One is direct quote and the other one is indirect quote. So what is direct quote? If you express the exchange rate in terms that how much units of local currency will be needed to buy one foreign currency. How much units of local currency will be needed to buy one currency. Then if you express like that, then in such case it will be known as a direct quote. Example, you will need 66 rupees to buy 1 US dollar. So this is direct quote. Whereas indirect quote is the opposite. Here you have to say, to buy one local currency, how much foreign currency they have to pay. To buy one local currency, how much foreign currency they have to pay. That is, to buy 1 unit or 1 rupee. 1 rupee in India, I mean 1 rupee, that is 1 Indian rupee. How much USD they have to pay? They have to pay 0.0151. So $0.0151 they have to pay to get 1 Indian rupee. So this is indirect quote, that how much units of foreign currency you have to pay to get 1 unit of local currency. Okay. Then there are two kinds of rate which is here. One is buying rate and the other one is selling rate. So here what happens is that first I'll tell you that buyer's rate, the other name of buyer's rate is bid rate, and the other name of selling rate is offer rate. So bid rate and offer rate, or we can also call it as buying rate and selling rate. So here the dealer who deals in the foreign exchange currency, what he'll do is, whenever he is buying currency from us, he'll buy it at 60 rupees. Okay, and whenever he is selling the same currency to some other person, he'll sell at 62 rupees. Now when he is buying at 60 rupees and selling at 62 rupees, suppose $1 he is buying at 60 rupees, and while he is selling that $1 he is selling at 62 rupees, that means here he makes a profit of 2 rupees. So 60 rupees here is the buying rate, whereas 62 rupees here is the selling rate. So that is buying rate and selling rate. Next we are going to talk about the exchange rate regime. Okay, so exchange rate regime are of three kinds. One is floating exchange rate, second is fixed exchange rate, third is intermediate exchange rate. So what is floating exchange rate? Floating exchange rate, here they tell that the exchange rate, let it be determined by the market forces of demand and supply itself. Let it have a free play. Okay. So here what happens is that the value of exchange rate of any country's currency is marketly determined. So depending on the market forces, the exchange rate is determined. Whereas in fixed exchange rate regime, what happens here is that here it is not free market forces. Okay, here the central bank or the government, they announce that what should be their exchange rate. Okay, how much should their local currencies value should be in terms of foreign currency. So here the government comes in and decides on the rate or decides on the value of a foreign exchange rate. Okay, so here this fixed exchange rate is also known as pegged exchange rate. Okay, so remember that. And the third one is intermediate exchange rate. Here what happens is that here normally they use free market forces to determine the exchange rate. But in case of the exchange rate is moving in one direction speedily, okay, if it is moving in one direction, either the value is keep on depreciating or keep on appreciating. If it is moving in only one direction, then in such case government will come in between and help to correct that. Okay, so the government or the central bank will come in, intervene in the market. So normally in intermediate exchange rate, normally it is floating exchange rate only, that is free market forces. But in case if it is moving in one direction speedily, then the central bank will come intervene and correct it. Next concept we are going to learn is the foreign exchange market. So what is foreign exchange market? So foreign exchange market is nothing but we can call it as a collection of markets and institutes that handle the exchange of foreign currencies. Okay, so that is what is known as foreign exchange market. So who and all are the participants in a foreign exchange market? Central bank, commercial bank, foreign exchange brokers, arbitrators, speculators. So all of these people are major participants in the foreign exchange market. So what are the features of foreign exchange market? Here the foreign exchange market is a worldwide market, as we all know. Here what happens is, this is actually one of the largest markets in the world where cash value is traded. Okay, and this also does not have any physical place. Okay, and then there is no hours of trading. Any time of the day, at any time of the day, whenever you want, you can exchange it. Then also here the volume of the trade, or the volume of foreign exchange getting traded worldwide, is very, very enormous. Okay, so these are the features of foreign exchange market. And also there are two types of transactions which happen in this foreign exchange market. One is spot, and the other one is forward transaction. So what is for spot here is that spot rate, or spot here means that spot transaction means is that right now you want to give your local currency and exchange it with foreign currency. Like right now, whatever rate is prevailing, at that rate itself you want to do the transaction, that foreign exchange transaction, that will be known as your spot transaction or spot rate. What is forward rate or forward transaction? What you do is, here today you get into an agreement that after 3 months or 4 months you will exchange your foreign currency or exchange your local currency at this rate. So that will be known as a forward rate or a forward transaction. Okay, so this is explained in detail in AS 11. So if you guys want to know more about this, you can watch the AS 11 lecture. Okay, next is changes in exchange rate. So here there are two kinds of changes that happen in exchange rate. One is either home currency depreciation or home currency appreciation. So here this home currency appreciation or depreciation, we usually see it in the view of floating exchange rate system only. Okay, so here what happens is that when we talk about depreciation, if here what happens, your local currency value decreases. That means before you to get $1, you used to give 60 rupees. But now today to purchase $1, you have to give 70 rupees. That means you have to spend more to get $1. So in such case, this will be known as a home currency depreciation. Whereas what is home currency appreciation? Before you were before you were getting $1 for 60 rupees. Now you have to only give 50 rupees to get $1. So so how much you have to pay to get $1 has reduced now. So this is nothing but home currency appreciation. That means value of our local currency has increased. Next concept is devaluation and revaluation. Okay, so devaluation and revaluation is nothing but it's just like depreciation and appreciation. So depreciation and appreciation, I told you that it happens due to free forces of market forces, market demand and supply. That means it happens in a floating exchange rate system. If the same thing happens in a fixed exchange rate system, or we can call it where the government comes and intervenes and wantedly either appreciates the value of money or depreciates the value of money, in such case revaluation and devaluation has happened. So devaluation and revaluation is a deliberate adjustment which is done. So deliberately the central bank will come and set into. So if there is a deliberate downward adjustment in the value of one's currency in relation to another currency, or we can say that if our home country's value has been depreciated in terms of another currency, then that will be devaluation if it is done deliberately. If deliberately there is an upward adjustment in the value of one currency or in the value of local currency in relation to another currency, that will be known as your revaluation. Deliberate is the important word here. Okay, yes, so that was your unit number 4. I hope you found it helpful. Unit 5 of chapter number 4. Unit 5 talks about the international capital movements. So what is international capital movement, or what do they talk about in this unit is that they talk about how one person can invest in a foreign country. Okay, in what and all form can he invest in a foreign country, or make his investment in a foreign country. Or we can also say, you remember when the BJP government came into force, everybody was talking that where Modi was going on, why is he jumping from a country to another and is not staying in his own country. So that time what he was doing is that he was telling other countries to invest in our country and to put their foreign capital in our country. Okay, so this is what is generally known as foreign investment. Okay, so in this unit we are going to discuss about two types of foreign investment. One is foreign direct investment and the second one is foreign portfolio investment. First I'll give you an overview and then we'll move on with the details of it. So what is foreign direct investment is that foreign direct investment is where one person, okay, suppose we'll take the example, if a resident of India, okay, if he is going and investing in an asset of a business of a foreign country, in the assets of a business of another country, then in such case that will be known as a foreign direct investment, that is directly going and investing in the foreign country's business or their assets, the assets of the business. So here what the person is going to do is he is going to be very active. He will control the ownership there, he'll manage the asset there, and he'll be a very active person in managing this investment. Whereas when we talk about foreign portfolio investment, what they say there is a resident of India is going to go and invest in the shares, debentures or securities of a foreign country's business. So in the direct investment, he used to invest in the asset, whereas in portfolio investment, he is going to invest in the shares, the debt and other securities of for other securities of foreign country's business. So here when he is when he is going to invest in the financial assets means the securities. So in portfolio investment, when a country's resident is going to invest in the foreign country's stocks, shares and everything, he is going to do it with a motive of earning short term capital gains, okay. Whereas in direct investment, foreign direct investment, he usually thinks of a long term there, and he there does not think of just getting profit from the business, rather he himself thinks as the owner of the business and works in such a way, he manages the whole business. Whereas in portfolio investment, he only works with a motive of short term and also earning money by selling the shares at a higher rate and getting profit from it. So this is the main difference between foreign direct investment and foreign portfolio investment. So now let's understand this in detail. Foreign direct investment. So I'll read out the meaning of foreign direct investment. So it is a process whereby the resident of one country acquires the ownership of an asset in another country, and such movement of capital involves ownership, control and as well as the management of asset. Okay, yes. So here, when will someone be known as a foreign direct investor or will be categorized as a foreign direct investor is a question mark. So whenever they get at least, they hold or acquire at least 10% of the company's ordinary shares or voting power. Okay, then in such case, such non-resident investor will be termed as a foreign direct investor. Okay. So this is the extent of control that they should have. Next is, what are the main forms of FDI or foreign direct investment? So what you can do is you can either open your own subsidiary in a foreign country or your own associate in a foreign country, or if there is an existing foreign country, in that you can take a controlling interest, you can do mergers and acquisition, you can do joint venture with a foreign country, or you can also do joint development of natural resources. So these are the main forms of FDI. By doing all these, you can take the control over the assets of the other country. Next is, they tell that there are three types of FDI. One is horizontal direct investment, vertical investment and conglomerate investment. So what is horizontal direct investment, vertical and conglomerate? This you would have already read in your strategic management subject, but here I again explain. So horizontal direct investment means that here you invest in a company which is in the same line of the business as yours. Suppose if you are making bread, that company also should be making bread, and if you are investing in their assets, then in such case that will be a horizontal direct investment. What is vertical investment? You move either up or down in the value chain. For example, if you are investing in a company where your company is making bread, where that company, what it does is it sells or it has a business of flour or maida or whatever you may call, which is used in the making of bread. So that company is in the raw material business, whereas yours is the finished goods. So in that up or down in the value chain, if you move, that will be known as a vertical investment. Okay, and final is a conglomerate investment. That here you want to diversify. You invest in such a company which is not at all related to your product in any way. Like you invest, having a bread company, you invest in a toothpaste company. Okay, so like that you have no relation at all. If you want to learn more about this, you can go and watch my SM lectures. So there you will get a better idea on what these three terms means. Okay. And then we move on to foreign portfolio investment. So in foreign portfolio investment, So it is a process whereby the resident of one country acquires ownership of a financial asset, that is securities in another country. Okay. So here what are the modes by which you can acquire the ownership of a financial asset? You can buy the stocks, bonds or any other financial instrument. Okay. Yes. So then next what they tell is what is the intention of investor here. So here the only intention of a foreign portfolio investor would be to earn a return through whatever investment they are making in the foreign securities, like short term capital gains. Okay. Yes. Then what is the nature of FPI? So here they tell that the nature of FPI is usually short term. Okay. Yes. Then we have a final topic where they talk about foreign direct investment in India, specifically in India. Okay. So here what are the initiatives that are taken by the Indian government to promote FDI? What does Indian government do? So like what Modi does, I told you. So here what they have done is they have made the approval of FDI automatic. So anybody, if they fulfill a set of rules and regulations for making FDI, they will be automatically approved to make the FDI. Next is all the procedures they have simplified. Then they have also set up something known as Foreign Investment Promotion Board. So to promote foreign investment. Then they have also allowed 100% FDI in a few sectors. Then they also brought a act known as Foreign Exchange Management Act, which will make the FDI process or facilitate the FDI process in a better manner. Then they have passed the SEZ Act. Then they have also encouraged the foreign technology collaboration agreements, whereas the foreign country people bring their technology into India and India use it in the Indian economy. Okay. And then there are two routes for FD, doing a foreign direct investment in India. One is automatic route, one is approval route. Automatic route, you yourself know that if you fulfill a set of rules and regulations, you can make FDI in India. Approval route means you have to take approval from an authority that has been prescribed. It can be the government or any other authority which is in place. Okay. So next is in instruments, how can an Indian company receive foreign investment? So how can an Indian economy receive foreign investment is by the issue of either they can issue equity shares, or they can issue partly paid equity shares, or they can also take investments in the form of fully and mandatorily convertible preference share and debentures. So if a foreign company wants to invest in an Indian company, then they either can buy the equity shares of Indian company. It can either be fully paid or partly paid, doesn't matter. Or they can also buy the preference shares and debentures of Indian company. But there is one condition when they buy preference shares and debentures of Indian company, that is, it must either be fully and also mandatorily convertible into equity shares into future. Okay. And finally, there is a prohibition of FDI, that these are a few businesses in which foreign investment is prohibited. I'll give you a few examples, and this is also one of the important questions. Example is in lottery business, gambling, chit funds, nidhi company, then real estate business, in the manufacturing of cigars or cigarettes or tobacco substitutes, or any other any other business model where the private sector is not allowed to make investment, like railway operations. So these are the few businesses in which the foreign company is prohibited to invest in Indian company. Okay. Yes, so I hope this unit 5 was also helpful to you all. So yes guys, we have come towards an end of chapter number 4. So I hope you found this revision helpful. If you did, please make sure to like, share and also subscribe to the channel, and don't forget to hit on the notification icon so you get notified every time I post a new video. Thank you.